All right, this is a quick three-part, and they're all pretty much business related. So let's start with the research and development. So R&D expensing, which is technically R&E. So the tax code refers to it by a different name, but neither here nor there. The real decision, if you will, is whether to take expense versus a credit. The credit is almost always better, but it applies only to incrementally increasing R&E. And I typically cover the R&E credit in the corporations course, Accounting 651. You don't see a lot of it on the CPA exam because it's a fairly detailed set of tests. In any event, when you incur these non-creditable R&E costs, under the old rules, you could either expense it immediately, so you just wrote off your research costs. You could defer those costs and then amortize them, or you could capitalize those costs. So we want to spend a little time on these just so we understand. So capitalize means you put the cost on the balance sheet until sold, worthless, or abandoned. That was not a very common choice of taxpayers, though it did exist for sure. The old defer and amortize, put it on the balance sheet, and when you first start realizing a benefit from that R&E, so let's say you generate a patent, and then you start selling or manufacturing with that patent, then you would start amortizing it over a period no less than 5 years, starting in the month of benefit. But now we've got a new defer and amortize. So now amortization starts the year expenses are incurred. You apply a half-year convention, whereas you used to apply a full-month convention. It's still over 5 years. And even if you abandon the project, you would still continue to amortize it over those remaining 5 years. So there's no method by which you write off any sort of capitalized R&E. So this has not been a really popular choice. There has been a lot of talk in DC about trying to get this revised, because basically it was put in to help pay for some of the other tax cuts. But as of now, this is still what's happening, and now we're all the way into 2023. So a retroactive adjustment is possible, but less likely than it was even a year ago. All right, there's another provision for excess business losses. So this is basically to try to reduce large business losses by being claimed by non-corporate taxpayers. So it effectively just puts a limitation. So adjusting for inflation, 2022 limits were $540,000 for married filing joint, $270,000 for all other returns. And what would happen is it was supposed to end in 2025. So if you incurred a giant business loss, it would be limited to those amounts in any particular year. The CARES Act suspended the excess loss limitation through the end of 2020 during the COVID period. But then when it came back, it came back strong because they extended it for a couple years. So now we have the business loss limitation in place through 2028. So Bettina's a single taxpayer. She's got wages of $20,000, business income of $5,000. She disposes of a passive loss activity for which she has accumulated suspended losses of $280,000. And I know we haven't really covered passive because I took a pass on it in chapter 6. It'll be back though, don't worry. So she's got this giant suspended loss of $280,000 that now she's disposed of the activity, she can take it all. Well, her excess business loss is the $280,000 minus the $5,000 of business income. So the single threshold for 2022 was $270,000, which means that $5,000 that she can't take, she now treats as a net operating loss. And the good news is we discuss net operating losses in the next video. Comes up right now.